He became one of the richest men in the world, and almost no one noticed it happening. No hype, no risky bets, no sudden breakthrough, just one decision, repeated over and over again. And somehow, that turned into over $100 billion. The question is, why did it work? Because what Warren Buffett understood wasn't obvious. In fact, it looked too simple to matter. And that's exactly why most people ignore it. But to understand how this started, you have to go back to a mistake he made at just 11 years old. At the time, it didn't seem like a big deal. But that one mistake would shape how he invested for the rest of his life. Warren Buffett was born in 1930, right in the middle of the Great Depression. Money was scarce, uncertainty was normal, and most people were focused on survival. But Buffett wasn't focused on survival. He was paying attention to something else. He became fascinated with how money worked. Not how to spend it, but how it moved, how it grew, how it multiplied. And that curiosity showed up early. At 6 years old, he was already experimenting, buying packs of Coca-Cola bottles and reselling them one by one for a small profit. It wasn't about the amount. It was about the pattern. Buy low, sell slightly higher. Repeat. Simple, but powerful. And once he saw that pattern, he couldn't ignore it. By the age of 11, he made his first real investment in the stock market. It seemed like a small step, just a few shares in a company called City Service. But what happened next would shape everything that followed. Shortly after buying the stock, the price dropped. Not dramatically, but enough to create doubt. And that feeling, that quiet pressure, is something every investor experiences. The question is what you do next. Buffett didn't wait long. When the price recovered slightly, he sold, locked in a small profit, avoided further risk. On the surface, it looked like a smart decision. But then something unexpected happened. The stock kept rising, not just a little, significantly, far beyond the point where he had sold it. And in that moment, a different kind of realization formed. Not about profit, but about timing. He didn't lose money, but he lost something more important. Opportunity. And that stayed with him. Because what he saw wasn't just a mistake. It was a pattern most people repeat for the rest of their lives. React too early. Exit too soon. Miss the real growth. And from that point forward, he approached investing differently. Not with urgency, but with patience. Not with fear, but with observation. And that shift didn't make him rich immediately. It made him disciplined. As he grew older, his interest deepened. This wasn't a hobby anymore. It became a system of thinking. He read constantly, studied businesses, analyzed decisions, trying to understand one thing: what actually makes something valuable. And eventually, that search led him to someone who had already spent years answering that question. Benjamin Graham. Graham wasn't known for flashy success. He wasn't a public figure chasing attention. He was something else. A thinker. Someone who approached investing with logic instead of emotion. And his core idea was simple: buy something for less than it's worth. It sounds obvious, almost too simple, but in reality, very few people follow it. Because markets aren't driven by logic. They're driven by emotion. Fear when prices fall, greed when prices rise. And those emotions distort decisions. Graham ignored all of that. He focused on value. And Buffett was drawn to it immediately. He didn't just learn the idea. He absorbed it, studied under Graham, worked with him, built his early strategy around that principle. And at first, it worked. He started identifying undervalued companies, buying them, watching them recover. The results were consistent, but something didn't feel complete. Because over time, he began to notice a limitation. Many of the companies he was buying were cheap, for a reason. Weak businesses, limited growth, no long-term strength. They could recover temporarily, but they didn't last. And that created a problem, because Buffett wasn't interested in temporary wins. He wanted something that could grow, without needing constant adjustment. Something stable, something durable. And that realization forced a shift. Instead of asking, "What is cheap?" he started asking, "What is strong?" That question changed everything. Because now, the focus wasn't price alone. It was quality, strong businesses, reliable earnings, clear models, companies that could survive pressure, adapt over time, continue generating value. And that decision didn't just change his strategy. It changed the scale of what was possible. Because great businesses don't just recover. They expand. And if held long enough, they multiply. But there was a catch. This approach required something most people struggle with. Waiting. Not reacting to short-term movements. Not chasing quick returns. Holding. Even when nothing exciting is happening. And that's where most investors fail. Because doing nothing feels wrong. But Buffett stayed with it. While others moved constantly, he remained still. While others searched for the next opportunity, he focused on the ones he already had. And slowly, that approach began to separate him. Not in a way that attracted attention, but steadily, year after year. And then came a decision that didn't look important at the time. A struggling textile company. On the surface, it looked like a poor investment. Declining industry. Weak outlook. Limited potential. Most investors wouldn't consider it. But Buffett saw something others didn't. Not in the business itself, but in what it could become. The company was called Berkshire Hathaway. And that decision would eventually lead to one of the most significant financial transformations ever built. But at the time, there was no indication of what was coming. No signal. No moment of recognition. Just another quiet move. Because nothing about Buffett's approach looked extraordinary. And that's what made it powerful. Because while everyone else was chasing results, he was building a system, one decision at a time. And what he did next with Berkshire Hathaway would change everything. Berkshire Hathaway looked like a mistake. A failing textile business. Declining industry. Shrinking profits. And yet, this is where everything began. Because Warren Buffett wasn't trying to save the company. He was using it. And this is the part most people miss. Berkshire Hathaway was never the destination. It was the vehicle. While others saw a struggling business, Buffett saw a structure he could control. And control meant something very specific. It meant he could decide where the money went. Not just his money, but eventually, much more than that. At the time, there were no signs that this company would become anything significant. But Buffett wasn't focused on what was visible. He was focused on what was possible. And that's where his thinking separated him again. Instead of trying to fix a broken industry, he began shifting the company in a completely different direction. Slowly, quietly, almost unnoticed, he started acquiring businesses. Not random ones, not trendy ones, carefully selected companies. He wasn't looking for excitement. He was looking for reliability. Businesses that generated consistent income. Businesses that didn't require constant attention. Businesses that could run without him. And then he made a move that changed everything. He entered the insurance business. At first glance, it didn't look special. Insurance isn't flashy. It doesn't create headlines. It doesn't attract attention. But Buffett saw something deeper. Something structural. Insurance companies collect money up front. People pay premiums before anything happens. And that money sits there, waiting. And this is where the real opportunity exists. Because that money doesn't just sit. It can be used. This is what's known as float. And this is where Buffett's strategy becomes powerful. Because float is more than just capital. It's time. Time between collecting money and needing to return it. And during that time, that money can be invested. Not for quick gains, but for long-term growth. Because now, he wasn't just investing what he owned. He was investing at scale. And doing it patiently. And this is where most people would have done the opposite. They would take that capital and chase aggressive returns. Try to grow it quickly, maximize short-term results. Buffett didn't. He stayed consistent with his philosophy, only investing in businesses he understood, only choosing companies with strong foundations, only committing when the long-term outlook was clear. And over time, that created stability. But the real test of any strategy isn't during growth. It's during uncertainty. And that moment came more than once. Markets dropped. Confidence collapsed. Investors panicked. And this is where behavior reveals everything. Because when prices fall, most people react emotionally. They sell. They step back. Buffett did something different. He leaned in. Not blindly. Not recklessly. But deliberately. Because he had already done the work. He understood the businesses he owned. He trusted their long-term strength. So when prices dropped, he didn't see a problem. He saw a discount. And this is the part almost no one is comfortable with. In 1973, during a major market downer, He made a decision that reflected everything he believed. He invested heavily in the Washington Post Company. At the time, the company was undervalued, not because it lacked strength, but because the market was reacting emotionally. And Buffett saw through that reaction. He understood the business, recognized its long-term position, trusted its ability to grow, and he held it for decades. And that decision multiplied his investment many times over. It wasn't a one-time success. It was a pattern. The same thinking applied again and again. Buy strong businesses. Hold them through uncertainty. Let them grow. Simple in theory, difficult in practice. Because this approach depends on something most people struggle with. Time. Time without constant action. Time without visible results. Time without reassurance. And that's where most strategies fail. He allowed his decisions to compound. And compounding is subtle at first. It doesn't feel powerful. It feels slow. But over time, it builds momentum. And once that momentum builds, it becomes difficult to stop. This is where his advantage became undeniable. Buffett kept building, year after year, without interruption. And that consistency created scale. By the time people began paying attention, Berkshire Hathaway had already transformed. It was no longer a textile business. It had become a holding company, owning businesses across multiple industries: insurance, energy, railroads, consumer goods, each one generating income, each one contributing to growth, and all of it connected by one idea: long-term thinking. Buffett wasn't reacting anymore. He had built a system that produced results without constant adjustment, and his role evolved. He wasn't just investing. He was allocating capital, deciding where billions of dollars should go, which businesses deserved expansion, which opportunities aligned with his principles. And he did it without complexity, just clarity and consistency, even when nothing exciting was happening, because he understood something most people ignore. Wealth isn't built in moments. It's built in stretches of time, long periods where nothing seems to change, until everything does. But the most important part of his story isn't what he built. It's how he built it. Because nothing he did was hidden. His strategy was simple. His thinking was clear. Yet very few people follow it. Not because it's difficult to understand, but because it requires discipline. The ability to stay still when others are moving. The ability to wait when others are reacting. The ability to trust a process that doesn't deliver immediate results. And over time, that difference compounded, until it became impossible to ignore. Not because it was loud, but because it was consistent. And in the end, that consistency turned a quiet strategy into a $100 billion outcome. And the difference wasn't intelligence. It was the ability to stay consistent when nothing exciting was happening.